our interest expense. That's what you do as an individual. You go bankrupt within a few years. And when a government does it, their currency collapses. So we're there. That's already getting ready to happen. And there doesn't really seem to be any fix for that. The least pain-free way of getting out of this would be to go to a new gold standard, do a currency reset, where we devalue the dollar massively and then go back on the gold standard. But that impoverishes everybody who trusted the government up until the point of the reset, because their bank accounts and their bond funds and their cash under the mattress all are devalued really dramatically. And, it's not clear whether the guys who do that can survive politically doing it. So you have to think twice before you just spring something like a new currency reset involving a massive devaluation on a populace. But that's the least painful choice. Everything else involves chaos. So hopefully they bite the bullet, they do the smart thing, even at their own political expense, and then we go forward with a sustainable monetary system based on gold.
Do you think President Trump has a plan to deal with the massive government debt?
No, I don't think he cares. And so I think that he's going to do a lot of good things. And he's going to bring manufacturing back to the U.S., and he's going to probably create a sustainable immigration system. But the whole debt thing is unfixable. The only way, like I said, the only way to fix it is to devalue the currency to the point where the debt's not onerous anymore. Maybe Trump will do that, but he hasn't expressed an intention to enact a plan like that. So no, I don't think he has that plan in place. I think that he might end up doing it, but I think it'll be something that gets hashed out in the crisis moment when things really seem to be spinning out of control. So it's not a plan, although it might actually happen.
The BRICS countries are meeting next week. What should we expect?
Well, they're kind of inching towards that gold-backed currency, and de-dollarization is something that's a word they're using a lot in their deliberations. So we'll see. They've kind of fooled us the last couple of times where they raised expectations and then didn't end up doing anything really dramatic. But they have been inching towards something like a new trading currency backed by gold, because they've been buying a lot of gold in the interim. Every year, the world central banks, mostly BRICS countries, buy about another 1,000 tons of gold. And that's a lot of gold. And each year that happens, they come out of it stronger in terms of their ability to back their currencies with something real. So we'll see. And also the whole Middle East thing is very scary to a lot of these guys in the BRICS, because if we're going to bomb Iran, why can't we invade Saudi Arabia and take their oil? Or why can't we start yet another proxy war somewhere? Because they don't think we're predictable, and that makes them nervous, and it gives them even more incentive to de-dollarize. So I think each BRICS meeting brings us closer to the point where something really dramatic happens.
What's the latest on real estate?
U.S. real estate is, or at least housing, is in a bubble in terms of price. It's never been less affordable for the average American than it is right now. So in that sense, we're in this big, dramatic real estate bubble, but it's been so slow. And all that's happened is that house prices go up a little bit each year. And, there's no massive number of deals being done out there, and no kinds of new, quote unquote, innovations being tried by individuals to play the housing bubble or stuff like that. It's just ridiculously high prices. And I think that very possibly could lead to a housing crash or a price crash. It wouldn't necessarily be anything that bankrupts millions of people. It would just be that prices of houses have to go way down in order to sell. So next 2 or 3 years, we could see 40% drop in U.S. home prices. Now, the dangerous part of the real estate market is commercial real estate, where especially office buildings, and you and I have talked about this before, So your listeners probably know the story of office buildings, but suffice it to say that a lot of them are not worth anything like the debt that it took to build them or refinance them. So somebody's going to have to eat those losses, and it could be local and regional banks in the U.S., which could trigger a banking crisis. So you want to see the government to do something dramatic, let a bunch of local and regional banks start failing, and you'll see a monster bailout or massive interest rate cuts or something like that. So that could be the catalyst for the next crisis, in other words.
Where can our listeners follow you?
I'm at rubino.substack.com, and I publish a newsletter there that covers actionable advice for all the stuff we just talked about.
John, thank you so much for being on This Week in Money.
Thanks, Jim. See ya.
My guest has been John Rubino. Find him on Substack at rubino.substack.com. Coming up, Martin Straith next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, British Columbia, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, good to be here, Jim. Thanks for having me.
U.S. non-farm payroll data came out on Thursday. It was better than expected, with 147,000 jobs created instead of around 100,000. Also, the unemployment rate in the U.S. dropped to 4.1% from 4.3%. What does that mean for the Fed and rate cuts?
Well, first of all, I have zero faith in these numbers. I mean, the numbers that they post and that you just quoted, that's from the Bureau of, Labor Statistics, I think it is. And it's based on a survey. It's not based on any actual data. It's not based on payrolls, for example. But on the surface, the markets react, and you would think that would be a positive for the U.S. economy, 147,000 jobs versus 100 or so. But when you drill down a little bit, very quickly, you see what's really going on there. And of those jobs, the state and local governments were the big increases there. So of the 147,000 new jobs, 73,000, so almost half, were government jobs. So then if we look at, what happened in the private sector, according to the ADP report on Wednesday, so the day before, and that report is actual payroll data. So that's real, that's real data. Well, the private sector lost 33,000 jobs in June, and that was the first monthly decline since, I think it was March 2023. So, and the expectation for the private sector was an increase of 95 to 100,000. So that 33,000 job loss, that was a big miss. And you got to remember that, private sector jobs are considered much more important to the overall economy than government jobs because they're the main engine of economic growth, innovation, sustainable job creation. So I think what's happening, is with all the uncertainty with the tariffs, the private sector's holding off new hires until they get some sense of, what's the impact of the tariffs going to be. So we have to remember also that this job data, it gets revised later in the month, and it's almost always revised lower. So now, how do these relate to the Fed and rate cuts? Well, I would assume that 147,000 new jobs, that's pretty much taking a rate cut off the table for July for sure. I think if the private sector jobs keep declining though, and that we start to, I think that will start to spook the Fed. And if inflation starts dropping, then I think we're going to see a rate cut, much more likely. Just checking here real quick. Just checking the CME FedWatch tool. So according to that, there's only a 4.7% chance of a rate cut at the Fed's July 30th meeting. But for their September 17th meeting, there's a 67% chance of a 25 point cut. So prior to the jobs data coming out this week, the markets had projected 3 Fed cuts this year, and now they're only expecting 2. Bottom line is, I think the Fed is watching the economic data for sure, but I think they're also watching the stock market. My thought is, if Powell sees the S&P 500 say down 1,000 points in September, I think he'll cut. But if they see the S&P 500 up 1,000 points in September, I doubt they would do any cut.
President Trump has said he'll announce a new Fed chair prior to Jerome Powell's term running out. What will that mean for the economy and markets?
Yeah. I mean, this has been an ongoing barrage of Trump beating on Powell. Yeah, he wants them to drop rates, and he doesn't want them to drop it a little. He wants to drop the rates all the way down to 1%. I mean, you think about it, the U.S. 10-year rate now is, it's about 4.3, 4.4%. I mean, that would be a huge drop. And yeah, he said he wants to announce a new chair in a month or so, well before Powell gets in. So that's gonna sort of spike the markets, I think. So this person, though, is now going to be Trump's puppet, and the Fed chair would be answering to the president. I mean, you think about that. I mean, that's how third world countries operate. I mean, I think it means we're going to see a lot of speculation, expectations of cheap, free money. This could be one of those buy the rumor, sell the news events. People were going to start front running the news, which I think may explain what part of the current rally is all about. The U.S. stock market is already at record levels. The stock market capitalization, it's 2 times the U.S. GDP. That's the highest, stock market capitalization ratio to GDP in the world. So if Trump controls the Fed policies, I mean, it'll probably work. Certainly it'll spike the market short term. But as I said, this is how third world countries operate. And once things start to fall apart, I don't think you would want to be invested in that kind of an environment. So I think, if Trump ends up controlling the Fed, I think it's going to crash and trash the currency. I think it's going to be inflationary. And I think that would be very good for gold. The problem is, to me, is that Trump's, he's 70, 78 years old. He's only going to be president for another 3.5 years or so. And he's not worried about the long-term effects. I think the only thing he cares about is the stock market. And if eventually he forces the rates to go too low, you're going to see inflation skyrocket. And then he's going to have to change his tune. But by that time, it's probably going to be too late. I mean, I really think having the Fed chair that is basically Trump's puppet is a very dangerous thing.
You use technical analysis, and you highlighted that there's a strong convergence approaching for the S&P 500. Can you explain it?
Yeah, there's a very interesting trend line. We looked at this quite a while ago, but it's quite an amazing one. So it's a trend line that goes all the way back to the Great Depression high in 1930. So if you draw on a logarithmic chart, and we draw a trend line from that high in 1930 to today, it shows that trend line got tested at the dot-com high, but that test it failed. So it couldn't break above that line. It tested it again just back in February this year, and again, that line held. So it tested and it's solid. And now it's being tested again today. So this is a 95-year trend line that has yet to be breached. So that's a pretty powerful resistance level, certainly in our books. Now, that doesn't mean the S&P 500 cannot or will not break through that level, but we're watching it really closely, because if that trend line holds, then we should see at least a pullback very soon in the S&P 500. Now, if the S&P 500 pushes through and above and holds above that level, that would be very bullish from a technical perspective. So I think it was George Soros who said, when he sees a bubble developing, he gets in and makes it bigger. And in a bubble, the path of least resistance is up. But, bubbles always burst at some point. So if we see the S&P 500 break through this trend line, then, stay invested, but start thinking about exit strategies down the road. Now, if the S&P 500 does not break through and this trend line holds in the next week or so, then you really want to start thinking about taking some profits and or adding some hedges.
Any other interesting trends you see in the equity markets currently?
One thing we're watching is the potential of a rotation into small caps. We saw that big run up in the tech stocks, and we're watching to see if we get some selling out of those big tech stocks and some buying into things like the Russell 2000. For example, this week we saw Meta hit a double top around 740, and then it pulled back. Now, we've also seen the IWM, which is the Russell 2000 ETF. We've seen it now up 9 of the last 11 sessions. So that the small caps are starting to make a move here. Now, while the S&P 500, the NASDAQ, the Canadian TSX, they've all made new all-time highs, the small caps have really lagged behind here. So small cap stocks, they're much more sensitive to interest rates and economic conditions. With concerns like stagflation, where you end up with a slowing economy, but inflation is still high, that hurts consumer spending. But if we get lower interest rates, then that's certainly going to help the smaller companies. Also, Trump's policies of cutting red tape, that's also going to help these companies. But the main reason we're watching this potential is simply based on technical analysis. These small caps ultimately need to do some catching up, which they've been doing in the last 2 weeks. So overall, the stock market rally is really focused on the very narrow AI tech. I mean, the S&P 500, it's only like 8 or 9 stocks that have done it, and they've moved very well. But the other, 492 or so, they haven't really not done very much at all. So similar to what we saw back in February, again, it was very narrow based, very narrow breadth. And back in February, the same thing was happening, and that's just before the S&P fell over 20%. We also have, we've got July 9th. That's Trump's deadline for the trade deals. So far, we've only seen 3 agreements, and there's no real details in them. You got Vietnam, China with some rare earth, and then you got the UK. So how many more deals are going to get done in the next 5 days? And if they're not signed, does Trump just impose his declared rates again? So those are things to keep an eye on. Another thing we're looking at is how, in the last number of years, we've seen in the markets how they interpret good news as bad news and bad news as good news. We've seen where the bad economic news, the markets jump higher. And the logic of that was that, well, if the economy is doing poorly, then the Fed would come into the rescue, cut rates, pump up liquidity into the markets. And what we've seen in the last few years is when strong jobs data comes out, the stock market actually went down because they were worried that if employment was good, then the Fed wouldn't cut rates. I mean, it's a crazy mindset, but that's what it's been like for the last couple of years. And I mean, they call it, the Fed put. But yesterday, with a good jobs report, the markets actually rallied. So that's what's suggesting to me is, it appears like the animal spirits are taking over the markets now. We got momentum coming in. This is where emotions override, both in greed and fear, that leads to irrational exuberance. So you get the bubbles and then you get the panic crashes. But we're certainly more into the irrational exuberance right now. But there's a lot of things starting to tell us as contrarians, we got to keep our head on a swivel here. The CNN Fear and Greed Index, it just spiked to extreme greed. The put-call ratio is now down to levels that often signal market tops. So again, I'm not saying this can't continue, but I'm definitely saying I'm sitting up and I'm taking notice here. So over the last few years, whenever we get a correction, it's been a V-shaped correction with a very, very quick rally recovery. I'm starting to wonder if investors today are so trained that on any correction of 10, 20%, the Fed just kind of rides in, saves the day, and so you should always buy every dip. So in the back of my mind, I'm wondering if we're approaching a scenario where the markets lull everybody into a false sense that you buy every dip, but then the market continues lower, trapping those buyers. So it's one of those reasons that you want to be holding gold certainly as a hedge. So really want to watch this next week or so. We want to see if that long trend line holds or if it's breached.
What do you see for the U.S. and Canadian dollars?
Well, the U.S. dollar, again, that's the reserve currency. And I think everybody's now aware that it's just been in a real steep decline lately. It's down over 12% since January. I mean, that's a huge decline, especially for the reserve currency. And, when you look at currencies, it's all connected. When the U.S. dollar is going up, other currencies decline. When the U.S. dollar is declining, the other currencies rise. So in the bigger picture, due to the trade wars, etc., we've been seeing this kind of theme of sell America. And where we, got many of these very large foreign pension funds and large institutions have been selling U.S. assets and looking to support their more domestic ones. And that means, you sell those assets, you're converting those U.S. dollars from those U.S. assets, and then you convert that back into the local currency. So that whole process pushes the U.S. dollar down. And now we've got the big, beautiful bill just got passed in the U.S. Well, that's going to increase borrowing costs by another, $700 billion. And that's according to the CBO office in the U.S. So the decline in the U.S. dollar, it's front page news. Everybody's aware of it. Everybody's bearish. And the U.S. dollar is oversold here. So now that we got stronger payroll data on Thursday, so we saw the U.S. dollar have a nice bounce, but the trend is still down. But I think we're going to see a rally here. It's overbought. It's oversold. I just saw a tweet the other day saying that the U.S. dollar is going to crash 40 to 50%. I mean, when you get sentiment that crazy, you're really likely at an inflection point here. When everyone gets on one side of the boat, that boat's likely to tip over. I think we're going to, see the bit of a rally here in the U.S. dollar. Now, if you look at the Canadian, it dropped all the way down to, low 68.3, something I think it was in February. That was a 23-year low. But since then, with all the tariff news and the U.S. dollar tanking, the Canadian dollar, it was up to, 73.7 last I looked this week. So, but again, the Canadian dollar, the strength in the Canadian dollar is primarily related to the weakness in the U.S. dollar. We did have last month where the Bank of Canada kept its rate at 2.75%, while the ECB dropped theirs to 2%. So that made the Canadian bonds more attractive. But next support would be about 73. But as I say, Jim, it's all connected, heavily driven by what happens in the U.S. dollar. If we do see a rally in the U.S. dollar, we're going to see the Canadian, the euro, the yen, etc., decline.
What's your take on precious metals?
Well, a bit of a mixed bag here. Gold has been pretty dull recently. It hit that all-time high in April at 3,500, but it's been just meandering sideways for the last couple of months. And the thing that's worrisome to me with gold right now is during this time that gold's really done nothing, we've seen the U.S. dollar plunging. And if gold can't rally while the U.S. dollar's plunging, that's not a good sign for gold. Now, the U.S. dollar, like I said, the U.S. dollar decline, it's all front page news. Everybody's talking about it. But back in April, when gold was hit $3,500, it got onto the cover of Barron's magazine, right? And since then, it has never been able to trade higher. The Barron's cover, it's really like the kiss of death for any sector they put on there. So since mid-May, the U.S. dollar has trended lower. The gold has not been able to move higher. Now, if the Fed does not cut rates, that will put pressure on gold. So we could see gold drop 10-15%, I would think. And that would be a good buying opportunity. Certainly something for people to keep in mind. Now, on the bullish side for gold, again, back to Trump's big bill here that just got passed. Well, that's going to potentially add another $5 trillion to the U.S. debt. Well, and that could give gold a boost because, that just means that's going to hit the purchasing power of the U.S. dollar. And if Trump finally does get the Fed to cut rates, well, then that's going to help gold. Also, if you look at seasonality, from July to September is actually a good time for gold. It's one of its strongest periods. And of course, we've got central banks buying of gold, protecting against currency drops and global uncertainty. You've got government spending more than they earn. I mean, what government isn't piling up debt? That makes gold more appealing, safe haven play, be able to hold value, protect purchasing power. Now, gold dropped about $30 on Thursday. It closed up a little bit today. Here it's about 360 up, so it was closed about 33.46. Near-term support is 32.80. Resistance would be 34.40. Long-term, I'm very, very bullish for gold. But short-term, I'm looking for a U.S. dollar rally, and that to me would probably mean a pullback in gold. Now, if we look at silver, silver's been making new highs, traded at 36.84 here. So that's just below its 13-year high where it hit 37. Now, if the price goes above, it can push back above 37.10. We could then just see a nice jump up to maybe $39. So again, that next resistance would be 37.10. But if we get a U.S. dollar rally like gold, I can see silver pulling back. Now in platinum, platinum's been really hot. It had a huge run up since mid-May. Set a new intraday high here on Wednesday at 14.45. Now it dropped about $50 yesterday on Thursday, up about 25 here on Friday. So, again, supply demand issues there, projected severe supply shortage for 2025. So that's a key fuel for the rise here. The World Platinum Council, they projected global supply to contract by almost 4%, which is pretty significant. And overall, again, we see broader bullish trend for the precious metals. So we're talking gold, silver, platinum, and palladium. And they're also gaining, even gold's already had the safe haven play, but these other ones are starting to get a bit of a safe haven play as well as their industrial play. So you got the geopolitical tensions, the obvious ones, Ukraine, Russia, Israel, Iran, US, Iran, China, Taiwan, all of that stuff, helps gold. Precious metals, again, provide, against loss of purchasing power. Again, we talked about those massive government deficits and debts. So we're going to watch to see if we get a pullback in gold. If we do, we'll likely see pullback in silver, palladium, platinum. But again, that's pretty much driven probably a lot by what happens in the U.S. dollar. And if we get these pullbacks, I see those as we're going to start loading up again.
What's happening in the energy sector?
Well, we saw oil actually, it's been pretty volatile here with all the action in the Middle East, but it popped again on Wednesday. So it went up to about $75, dropped to about 65 after the U.S. had bombed Iran, and then things calmed down a bit, and we had the ceasefire. But it popped on Wednesday as Iran suspended cooperating with the UN nuclear watchdog, so that's created some tension. We also saw reports that Israel was planning more bombing on Iran's nuclear sites, so that kind of pumped oil up a bit. But if it was only about supply and demand, right now oil would be much lower today. We kind of forecast it to be in the mid to low 50s. But again, the recent spikes, such as we saw in the July jump, again driven by Middle East tensions. But again, as we saw, those kind of spikes are pretty short-term catalysts. I mean, the facts are we have a declining demand in China. We've got soft economic data coming out of the U.S., Europe, and Canada. Supply is not excessive, but it is on the high side. Based on seasonality, typically June to September is a weak period for oil. Oil can trade between 55 and 75. Again, the 75 was that quick spike to the U.S. bombing in Iran. It closed today at 66.83. If it pushes through and can hold above 67, then 70 is possible. But again, if geopolitical tensions calm, I would say we're going to drop below 60. Like I said, mid to low 50s is possible here, and especially if we see a rally in the U.S. dollar. Now, other than a geopolitical event, which of course certainly could happen, I expect oil to move lower. But near the fourth quarter, I think we're going to start to see oil ramp up and start to hit up to maybe $75, $80 range and maybe even $90. Now, the other main one we like is uranium. Prices closed at $77.40. So it's holding most of that rally that topped out at the 7-month high at about $79, just under 80. So that's up $15 higher than the low in March and April. So now the markets are continuing to look at fund buying that will impact prices by utilities. So the Sprott Physical Uranium Trust, which we own, by the way, they said they're going to buy another $200 million worth of physical uranium. And that's twice the amount they signaled earlier. And then we've got, they got the U.S. government signaling its support for domestic uranium enrichment capacity. They're cutting regulations. They're accelerating license for reactors. So all of that's positive for uranium prices. We're seeing similar things in other countries. We saw Germany where they had shut down all their nuclear plants. Now they're looking to start them back up. So we see, big believers in nuclear and uranium for investors. Uranium stocks were a bit overbought here. So, we would be looking to add at any pullback.
What do you see ahead for Bitcoin?
Well, Bitcoin's done really well. With all the tariff uncertainty, it's really performed pretty well. It wasn't a very near-term slight downtrend channel, but on Thursday, it just broke through that channel. So it's just under 110,000. Now it's dropped back below it today. It's down to a couple $1,000s today. But, as we've highlighted previously, Bitcoin has been acting much more like, the NASDAQ and the tech stocks than it has like a safe haven play like gold. The $100,000 mark was key resistance for Bitcoin for quite a while, and now it's very strong